Hello everyone and welcome back to my channel. Today we will be going over the current market conditions and how I am navigating them. We will cover stock picks and ETFs. Here are the timestamps. Before we start, I would like to thank those of you who have used my referral link to sign up for Wealthsimple Trade. I hope that those extra $10 will help you guys get started on your journey to financial independence. If you guys want to trade stocks with zero commissions, check out my link in the description for Wealthsimple Trade. As you all know, over the past month, we have seen a correction in the markets. Through its lower volatility, the TSX index has fallen less than the S&P 500, which is due to its massive exposure to the volatile FANG stocks. We're going to start my stock picks with the Canadian National Railway, ticker CNR, on the TSX and CNI on the New York Stock Exchange. The company's shares have appreciated 18.85% over the last year. It is a massive $100 billion company that trades at a PE of 28. At the current price, it offers a 1.64% dividend. This company is a staple of the North American economy, with a huge network and a massive economic moat that almost guarantees positive returns over the next couple of decades. This is why billionaires like Bill Gates put a significant amount of their net worths in CNR. I highly recommend you guys do some research on this company and add it to your watch list in the case that it provides a buying opportunity. The next company that we will look at is Kirkland Gold, ticker KL on the TSX. With the economic uncertainty that is approaching due to a delayed stimulus and the commencement of second waves in various parts of the world, gold will most likely maintain its current price or even increase. Kirkland has returned 12.98% since January. It is a $12.5 billion company that trades at a 16.6 PE ratio with a 1.02% dividend. The gold mining company has seen nothing but explosive growth over the past years in revenues and net income. Their current guidance, which I should mention they are on track to meet, says that they will produce 1.35 to 1.4 million ounces of gold this year. If we take the lower end of that and multiply it by today's price of gold, $1,800, we get that Kirkland is projected to and is on track to producing $2.52 billion in revenue this year, about 30% of an increase from last year's revenue. All of this comes with higher profit margins because Kirkland does not need to spend money for the price of gold to go up. It just simply profits from the gold going up. I would recommend you guys check out a deep analysis into the company done by Daniel Pronk. I will leave the link in the description of this video. You guys should go check that out. The last company we will look at is my favorite company in my portfolio, Granite REIT, ticker GRT.UN on the TSX and GRP.U on the New York Stock Exchange. The company's shares have appreciated 18.3% since the start of this year. Granite is a REIT that focuses on industrial, warehouse, and logistics properties. They are a $4.3 billion company. I pasted in their price to book. I know it looks kind of funky, but the point is that you should not analyze how expensive a REIT is by its PE ratio. So I'm going to be using price to book to analyze how expensive it is. It trades at a price to book of 1.22. This is more oriented for dividend investors. It yields a 3.8% dividend. I have done a video on this stock with a deeper explanation for my bullish case on the company. Essentially, this company's increasing tenants are companies like Amazon. The explosive growth in e-commerce has set up this company for a great next decade. Warehouses are an increase of demand to act as distribution centers for online retailers like Walmart or Amazon. I highly recommend you guys watch my other video on this company and do some further research on this company so you can decide what a good entry price is for this stock. Now, I will cover 3 ETFs for those of you that are looking to invest more passively. I myself have been considering selling some of my positions to put that money into ETFs. I have decided that by the end of this year, I will do a deep analysis of all of my positions and ideally sell off 30% of my portfolio and put this into these 3 ETFs. We start with 2 Vanguard ETFs. The first one is VFV, which tracks the S&P 500. We can buy this unhedged ETF in Canadian dollars with a dirt cheap 0.09% MER. The second ETF is VUN. It is a total market ETF for the United States. And same as VFV, it trades in Canadian dollars. It has a little higher, but still super cheap, 0.16% MER. I recommend you guys do research on both of these ETFs and add them to your watch list. I know I will be buying in if I see a second crash. Lastly, we have an ETF from BlackRock called XIC, which tracks the TSX index. It has a dividend yield of 2.69% and an MER of 0.05%. Compared to the Vanguard ETFs, this ETF from BlackRock will yield a little bit less capital appreciation, but it is a little bit more stable and provides a higher dividend income. So it is good to balance out high capital gains with a little bit of dividend income. That is all for this video. Thank you all very much for watching, and please do not forget to like, subscribe, and leave a comment with your opinions. I will see you in the next one.